Well, hi everyone, and welcome to the Buffett and Beyond Saturday Market Recap Letter, and this is June 17th, 2023, and these methodologies are based on the book Buffett and Beyond, second edition. Folks, remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And this week, the market continued its winning ways as the rally broadened out to include almost all of the S&P 500 stocks. How far can this rally continue? Well, we're going to find out next week. In our weekly stock analysis video, Oracle beat expectations. However, another stock in the computer software business is a much, much faster growing stock than Oracle. Cadence Design has been around for a while, and it may be a candidate for our growth portfolio. In our ETF video, well, our top stocks in the semiconductor ETF are up 75% this year already. And we're taking a look at a number of other ETFs because we can see that most of them are participating in this market rally. Folks, we just love it. Now, let's take a look at the S&P 500. And the red bands are Bollinger Bands. They are volatility bands. Center line is the 20-day moving average. And we can see that this market has been pushing this top band up, and just the other day closed above the top band once again. And the rule of thumb here is that 95% of the market stays within those bands. When it goes outside the band, either one way or the other, it's a strong market. So folks, we're liking what we see. And then down here, our intermediate term indicator is doing very, very well. And as long as it's pointing up, we're happy campers, folks. And I want to show you the RSP. Now, the black lines are the S&P 500 index that we always hear about, and it's capitalization weighted. That means you take the number of shares a company has that are out there in the public, and you multiply it by the price. So a stock like Microsoft, Amazon, Nvidia, all those stocks have high prices and they have a lot of shares out there. They're huge companies, but they affect the index much more than a digital data whack that has maybe 12 shares outstanding and has a lower price. So the bottom line here, the yellow line, is the RSP, and that stands for the S&P 500 but equally weighted stocks. So in other words, digital data whack counts just as much as a move in Microsoft. So 1% move in a smaller stock represents the same amount of index movement as a 1% move in a Microsoft or an Amazon. What everybody was worried about just the beginning of just in May, and this is May, this whole rectangle in here, was that the market was being driven by the very large stocks. In other words, about 10 stocks or a little bit more, but pretty much 10 stocks were moving the entire S&P 500. And they were, of course, the Amazons, the Microsofts, the Googles, and Nvidia. While the rest of the stocks, the smaller stocks that didn't contribute much at all, were being actually sold off. So we had a real divergence here in the market, and it wasn't a good divergence. And right about here, right in the end of May, the beginning of June, we saw a wide divergence, and everybody was calling for a correction in the market because most of the stocks in the S&P were not participating in this rally. Then something magical happened as soon as June began, and all of a sudden more market participants began buying the less well-known stocks. And I shouldn't say they're less well-known. We're talking about the Caterpillars and Tractor Supply and some of the retail stocks. And all of a sudden, you can see both the S&P 500 capitalization weighted and the S&P 500 equally weighted stocks were moving in tandem to the upside. This means that all the stocks in the or just about all the stocks in the S&P 500 were participating in this rally. That is a good sign. Then when we look at the candlesticks, we're looking at the 50-day moving average here, and we can see the S&P 500 is really getting ahead of itself, and we're looking for that reversion to the mean. Reversion to the mean in this case will mean the 50-day moving average moving up, and then possibly the index itself, the S&P 500 here, moving down to meet the uprising 50-day moving average. And you can see we have a reversion to the mean here, had a reversion to the mean here, and that's what we mean by when we talk about reversion to the mean. In this case, the mean is the 50-day moving average. So we do expect some kind of decline or a broadening out of the market where the market goes no place for a while or even down a little bit, but this 50-day moving average definitely is moving up. So we'll have a meeting of the minds right in here somewhere, but it'll be a slow moving market. But everything is participating in the market right now. And when we look down here, we can see our intermediate term indicator is now overbought, but it hasn't turned down yet. So we're happy as long as we see this pointing up. Now, portfolio protection. Well, the June 16th put option that we buy SPY puts or SPX puts to protect our portfolio. This put expired, and this is about a $135,000 portfolio, so we need 3 puts. And we bought the September 15th put, which is very, very inexpensive right now because everybody is getting on the bandwagon. All the people that missed and I'm talking about money managers, the money managers who missed this great rally, who weren't fully invested, are really forcing or being forced to get into the market, and that's why we're having this beautiful move up. So buying puts right now, for those of you who want to be protected all the time, we have some puts. We just went out and bought the September 15th put. We sent that letter out yesterday, which was Friday, to all our participants, all our subscribers. So now we're left with these 3 puts. And those of you who don't buy puts all the time, we didn't buy this put yet because we are still heading up in the market. So when the market turns down, when this indicator starts to turn down, then we can buy some put protection, such as the September SPY 410 put, or we do some other strategies, trailing stops we like to use. So we'll protect ourselves once that indicator does start turning down. Now, some of you asked where you get the money to buy those puts, because that could be very, very expensive. Well, when the market goes up, we get into just a few trades, not too many, and we will buy some stocks, and they call that swing trading, but just hold on for a little while, and it gives us the money. You can see that most of our trades are good because the market's been good, and therefore we will gain extra money in order to buy our put protection. And we do this for a lot of portfolios, and this also helps the money managers who are following our strategy. The money managers will do a few of these just to get enough money for their clients, so the clients don't have to pay the fees from the appreciation of their portfolios, because our growth portfolio is up, as of the close Friday, was up about 32%. So we're doing really well this year because of the tech stocks, because of the semiconductor stocks. And this extra money goes to pay management fees. So in effect, money managers can tell their clients they are providing, in other words, the money manager is providing value added to the portfolios, which pay for the fees, rather than taking the fees out of the appreciation of the portfolio. Nice little strategy we have here, folks. So we hope the market just keeps going up, but we've made more than enough to pay for put protection plus the fees so far this year. So, folks, we've had a great week. We've had a great month. We've had almost a full first half of the year, which has been very, very good. So we have a 3-day weekend here. You go out, you be with your family, be with your loved ones, go out, take your mind off the market, have fun for 3 days, be safe, stay well, and folks, we'll see you back here on Tuesday.